Committee will return to order. We'll now recognize our second panel of witnesses. Thank you for waiting so patiently through the first panel. Mr. Douglas Fecker is the president of Right Pat Credit Union in Fairborn, Ohio. Mr. Stephen Zeisel is the executive vice president and general counsel of the Consumer Bankers Association. Mr. Michael Calhoun is the president of Center for Responsible Lending. Mr. Mark Calabria is the director of financial regulation studies at the Cato Institute. Thank you so much for being here. It is policy of this committee that all witnesses be sworn before they testify. If you'll please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth? Thank you. You may be seated. Let the record reflect that the witnesses answered in the affirmative. We'll now begin with Mr. Fecker for his testimony. As you have heard, the light system is very simple for opening statements. Green means go, yellow means hurry up, and red means stop. You'll have 5 minutes to summarize your opening statement. Mr. Fecker.
Thank you, Chairman McHenry, Ranking Member Quigley, members of the subcommittee. Thank you for the opportunity to testify at today's hearing. My name is Doug Fecker, and I am President and Chief Executive Officer of Right Pat Credit Union, a federally insured, state-chartered credit union serving over 225,000 members with total assets of $2.5 billion headquartered in Fairborn, Ohio. Credit unions are not-for-profit financial cooperatives owned by their members, and our job is to help our members improve their financial well-being. Today, credit unions face a crisis of creeping complexity with respect to regulatory burden. This burden will ultimately, in my opinion, have a negative impact on credit unions' ability to extend credit to members at reasonable costs. It is not just one new law or revised regulation that challenges credit unions, but the cumulative effect of all regulatory changes. Every hour and dollar that is diverted to deciphering these new regulations is a resource that cannot be spent working with our members and will have to be paid for out of the interest we earn from consumer loans. It was the actions of the larger financial institutions that created the need for stronger consumer protections. We understand this. However, it is important that the CFPB recognize that the cost of compliance does not vary much by asset size and is a much greater burden for smaller institutions. The Dodd-Frank Act required the CFPB to review all the statutes and regulations under its jurisdiction. As part of this process, the CFPB has routinely reached out to the credit union system to seek our perspective and input on their rulemaking process. We appreciate their effort and look forward to continuing to work with them. However, because of the scope of the review, there could be dozens, if not hundreds, of additional operating changes that credit unions will be required to make. To help give the committee an idea of what credit unions are facing, in just the past 6 months, the CFPB has issued a 300-page remittance rule, an 1,100-page proposal on Respatila, a 293-page proposed HOPA proposal, and we are quite apprehensive about the qualified mortgage regulation and other related rules the CFPB is working on. The fact of the matter is it is not necessary for credit unions to be subjected to a substantial increase in compliance costs. Congress granted CFPB the authority to exempt credit unions and other parties from a number of the regulations the Bureau is developing. We are very concerned that instead of exempting credit unions, the Bureau seems to be picking and choosing when to use the statutory flexibility Congress provided. We believe the Bureau has more authority to extend relief to credit unions from certain compliance responsibilities that it has not exercised. If we want credit unions to maintain and expand access to reasonably priced consumer loans, Congress should, at the very least, aggressively urge the CFPB to utilize its exemption authority so that regulations that are intended for abusers and the largest of financial institutions do not have the unintended consequence of overburdening credit unions and other smaller financial institutions. The Respatila proposal is massive, and reviewing of the document will be a problem for most credit unions. I'm personally concerned that things like this proposal, along with all the other changes occurring in the mortgage market, may make many smaller credit unions simply throw up their hands and quit making mortgage loans. The proposed rule would change many aspects of the current way of doing business. While it is difficult to assign a dollar figure to the cost of compliance for these changes, when a regulation is changed, make no mistake, there are costs to be paid. Staff time and credit union resources must be used to comply with the changes. Forms and disclosures must be changed. Data processing systems must be reprogrammed. It also takes time to discuss these changes with credit union members, and at times members get frustrated because of everything they're being put through. Regarding the definition of a qualified mortgage, or QM, the Bureau was given broad flexibility to define QMs. We agree with this. The Bureau's broad jurisdiction in this important matter will undoubtedly reshape the mortgage process and determine the cost for borrowers and liability exposure for lenders. The CFPB should consider the broadest possible QM definition that balances the needs of responsible lenders and consumers to ensure maximum access to credit and minimal market disruption. A common element of all the new rules emanating from the Bureau is a significant increase in cost to credit unions. Faced with increased compliance costs, we will be forced to reduce some other costs that we can control. As an example, one of our most controllable expenses is loan losses. The only way we can lower loan losses is to tighten credit standards, which will impact creditworthy borrowers on the margin. This will be particularly harmful to those Americans hurt most by the recent financial crisis and recession. Chairman McHenry, credit unions respect the idea of strong consumer protections. Such protection is in our DNA. As a matter of public policy, I believe we should be encouraging responsible community-based lending rather than discouraging it through costly compliance burden for groups that were never part of the problem in the first place. We urge the subcommittee to ensure the Bureau exempts credit unions and other small financial players in their communities to the greatest extent possible. Thank you for allowing me to testify today. I'll be happy to take any questions.
I certainly appreciate the summary of your testimony, and I certainly appreciate your full written testimony as well. Mr. Zeisel.
Thank you. Mr. Chairman McHenry, Ranking.
You can refer to me as Chairman McHenry if you'd like. Thanks. No, thank you so much. I appreciate it. Thanks. Rooster. Thanks.
Issuing the final QM rule. If the Bureau Thanks. Can you hear me now? These cards, prepaid cards, have proven to be an attractive, safe, and convenient method of conducting financial transactions at retail locations or online, and have opened the door to financial inclusion to many who were previously underserved. It is important that future regulations adopted by the CFPB do not increase costs, decrease availability, or stifle the innovation of this product. In conclusion, we appreciate the CFPB's mission of protecting consumers. However, we believe the Bureau has the responsibility to ensure that the new rules it issues will not adversely impact the availability of credit. Indeed, the Dodd-Frank Act requires it. It is important the Bureau continues to keep the dialogue open with all market participants. This will ensure it has the information necessary to understand how theoretical rules and regulations will impact consumers once they are applied in a real-world environment. It is also important the Bureau takes the right approach as it moves forward and provides enough time to implement any required changes and to coordinate the timing of such changes with other rules. The more certainty the Bureau can give to the financial services community, the better we can innovate and provide the products and services that consumers need. We appreciate the opportunity to share our views, and I look forward to answering any questions you may have.
Well, thank you. Even with the little speed bump we've given you, you handled that very well. Mr. Calhoun.
Thank you, Chairman McHenry, Ranking Member Quigley, for the opportunity to talk today about the need for both consumer protection and broad access to credit. At the height of the mortgage boom and resulting crisis, what were previously small niche products came to dominate the market. No-doc loans, loans with deep teaser rates and exploding payments were marketed without a determination of the sustainability of those loans. As a result, the U.S. had some of the worst quality loans, highest default rates, and worst consequences. In addition, investors who purchased AAA paper, rated AAA, experienced losses often exceeding 40% on their investments. Understandably, they were scared away. The CFPB was created to address the failure of other regulators who had the authority to establish safeguards but did not do so because they were focused on other mission priorities. While some have argued the CFPB has constrained credit, credit constriction followed the mortgage crash and predated the CFPB. Indeed, the CFPB rules we're talking about today, such as the mortgage rules, have not yet been finalized and would not take effect for another year and a half from now. I also point out that while there has been widespread litigation in the mortgage market, these have not been borrower claims, which have remained rare despite widespread abusive lending. Instead, these have been so-called putback claims, where investors who purchase loans have sued originators based on the terms of those sales contracts that the loans did not meet the represented standards. We have seen not just claims, but tens of billions of dollars of payments on those putback claims, and that is a major driving force in constraining credit right now. I'll focus my oral testimony here on the mortgage market because it is so important to families and the overall economies. One of the most important rules the CFPB will produce has been noticed as the qualified mortgage rule. There are three interrelated issues regarding that rule. The first is, do you have a broad or narrow QM market? We have argued strongly for a broad QM market, and we're heartened by the comments that Director Cordray made today that seems to be the direction they're headed. The second is, do you have bright line standards or more subjective standards? We initially, in our filed comments with the Federal Reserve, were concerned about bright line standards constricting credit. We have changed that position based on input from lenders who said that they needed bright line standards so that they felt certain when they wrote a loan that they knew that it was a qualified mortgage. However, one of the consequences of bright line standards is no matter where you set those standards, if you want a broad market, you will allow a significant number of unaffordable loans to meet that standard. So, for example, it's widely proposed that one of the core measures be debt to income and that be set in the mid-40s. That works for a lot of families, but a family on a smaller fixed income, a loan with a 45% so-called debt to income ratio, we've seen is often unaffordable. We consequently support a rebuttable presumption, and we note that these are very tough claims to make. You have to prove there was no ability to repay the loan at the time it was made, not based on later events. These are individual, not class actions, and you must prove causation, not just a technical violation. We have submitted joint comments setting out this structure with lending institutions who originate the majority of the loans in this country supporting this three-part structure. Two other quick important points. We support simplification. The QRM, which determines risk requirements, risk retention, should be the same as QM for simplification and to provide broad access and regulatory reduced burden. Lastly, on the HOPA rule, I would note the statutory reforms did not change the HOPA interest rate trigger. It changed how it's calculated, but it left it at the same place, which in today's market is over 10% interest rate on a first lien mortgage. The points were revised in a way that followed state laws such as North Carolina. Thank you again for the opportunity to testify today, and I look forward to your questions.
Thank you. Dr. Calabria.
Chairman McHenry, Ranking Member Quigley, distinguished members of the subcommittee, I thank you for the invitation to appear at today's hearing. Before I begin, I'd like to really commend the Chairman's efforts to bring oversight to Consumer Financial Protection Bureau. Given the unusual structure of the CFPB, one that I believe reduces transparency and accountability, and the questionable manner in which its leadership was put into place, diligent and constant congressional oversight is badly needed. In my opinion, had Congress fulfilled its responsibilities in previous years in regards to such entities as Fannie Mae and Freddie Mac, we might have avoided the financial crisis altogether. As the CFPB runs the same risk of politicizing our consumer credit markets in a manner similar to which our mortgage markets were so highly politicized, I believe aggressive congressional oversight is needed in order to avoid both future financial crises and to maintain a healthy economy. A particular focus of my experience has been in the area of federal mortgage finance, as housing remains one of the largest drags on the economy and is particularly sensitive to credit conditions. I will place the bulk of my testimony on CFPB's activities in this area. I will emphasize, however, the point has been repeatedly made that I agree with that the CFPB has not issued a whole slew of regulations. I see the larger problem as the whole body of regulations and law which the CFP inherited. The problem facing our housing market is a combination of weak demand and excess supply. One of the constraints on demand is mortgage availability. If a borrower is prime and can make a substantial down payment, then mortgages are both cheap and plentiful. If one is not, then a mortgage is difficult, if not impossible, to get. This decline in mortgage availability derives from a variety of factors, some good, some bad. For instance, the most irresponsible lending, with the exception of FHA, in my opinion, is gone, at least for the moment. I think that that's a good thing. Unfortunately, most of the Alt-A and higher quality subprime is also gone. That is not such a good thing. By my estimate, about a fifth of the mortgage market has disappeared, holding back housing demand. I would again emphasize we don't want all of that to come back. As I noted in my written testimony, the Federal Reserve has made the same observations in relation to our mortgage market. One of the factors contributing to that disappearance, in my opinion, is Federal Reserve interest rate policy as it combines with mortgage regulation. Under HOPA, which was mentioned, there are two triggers. One is the HOPA and one is the higher cost, which was created under Federal Reserve regulations. Under the HOPA trigger, with the Federal Reserve's current interest rate, any mortgage over 5.5% is considered high cost. These mortgages now carry considerable regulatory, regulation, and litigation risk. I think it's fair to say that historically 5.5% is a great rate, not a predatory one. While one should always keep in mind that economics does not offer the luxury of a natural experiment, we cannot hold all equal, I believe the expansion of consumer finance regulation since the financial crisis has increased consumer credit costs while decreasing its availability. This expansion has also reduced the effectiveness of monetary policy. While the Federal Reserve can lower its target rate, its ability to impact the economy is limited by the willingness of lenders to extend credit. One area that appears adversely impacted has been the area of credit cards. Despite a 5 percentage point decline in the federal funds rate since 2007, the interest rate on credit cards has fallen by only 1 percentage point. As the credit card market, in my opinion, is fairly competitive and rates can be adjusted to cover interest rate, the increased spread of rates over other benchmarks suggests increased credit and legal risk. The largest declines in credit card lending did not occur during the depths of the financial crisis, but since the implementation of the CARD Act. Economist Josh Wright at George Mason University and David Evans at the University of Chicago predicted in 2010 that the CFPB would raise the cost of consumer credit by an average of 160 basis points. Examining the spread of various forms of consumer credit, especially that in the credit card market, over the Treasury rate, it would seem to me that that estimate is too low. Again, as mentioned earlier in the earlier panel, my guess is that the CFPB, given its inherited body of regulation, has increased consumer credit by at least 2 full percentage points. Evans and Wright use that estimate to say that the CFPB will likely decrease job creation by 4.3%, accepting that the predicted increase in borrowing costs is likely low. I think we need to surmise that net job creation has been reduced by about 5%. This translates to about 150,000 fewer jobs that would have been created that were not. Further evidence that regulatory and litigation risk are holding back lending and other sectors less subject to regulation have, I think if you compare those other markets, for instance, take the auto loan market. Subprime credit is readily available for auto loans, and despite seeing a similar decline to that in the housing market, the auto market has rebounded. Of course, the auto market is not subject to these same consumer protections as the mortgage market. If you don't pay your car loan, for instance, they take your car. It's not the situation where if you don't pay your mortgage, you can be in your house for years on end without ever making a payment. While some would claim that by being able to drag out these obligations is consumer friendly, the result is clearly reduction in credit and a weaker economy. In closing, I would like to emphasize that I think CFPB is only one of many obstacles. In fact, I think I should emphasize that much of the problems at CFPB were created by Congress, and Congress deserves probably far more burden of the blame than does the CFPB. So again, I should emphasize that I think our entire body of financial protection laws needs to be reexamined, rewritten in a way that would be both protective of consumers and the economy. Thank you. I look forward to your comments and questions.
Thank you for your testimony, and certainly appreciate the panel being here. And I know you are all busy individuals, but I certainly appreciate you taking the time, either traveling across town or traveling to Washington, especially for this. I would like to begin by, I'll recognize myself for 5 minutes, Mr. Zeisel, with the Consumer Bankers Association. When you're talking to your members, what are their biggest concerns? What are the biggest issues that they're facing with the CFPB?
Well, thank you, Mr. Chairman. In many ways, there are 2 aspects of our attention that's relevant to this committee's oversight. One is the potential for actions by the CFPB, and as has been noted, only one significant substantive regulation has been issued to date. A lot of it is uncertainty about what the CFPB is likely to do going forward as it regulates products and services using the powers that have been given to it under the Dodd-Frank Act. But also through the examination process itself. A lot of our members are examined by the CFPB. There are banks over $10 billion, and the examination process is new. A lot of new examiners who are under a new boss, as it were, and operating with a new set of supervisory guidelines. And there's a lot of learning process going on there. So banks are facing it on the exam side. They're facing the sort of uncertainty about the future on the regulatory side. I will add that the one regulation that they have issued, the remittance rule, already seems to have an impact on the products that they can offer And so there's some very real concern there as well.
Mr. Fecker, have you seen that with the question of remittances?
Yeah, actually, as was stated before, that was the one rule. Credit unions look at the CFPB with a great amount of uncertainty also, and the first clues that we get are the remittance rule. Now, there was an exemption built into that rule, but that exemption is so low as to not really, the only people it exempts are the people that weren't doing it in the first place. My own credit union makes about 25 remittance payments a month. It is quite likely we will discontinue that service because the cost of the regulation simply won't support such a small number. We were hoping for a larger exception. So, and then the next clue we get is an 1,100-page document, and with all due respect to the Director, when he said that most of it is just justification, the fact of the matter is we ignore most of that at our own peril. We have to read the whole thing. There are parts of that thing that we just can't take the risk of not understanding what's in that. So while the comment and point was made earlier that these regulations, very few of them have been put out yet, the amount of uncertainty and frankly fear among small credit unions that this thing will roll up on them is real, on the street, real.
So how large is your credit union?
We are a large credit union. We are $2.5 billion in assets.
And how many folks do you employ?
We have about 490.
Okay,
Right around
substantial. So in terms of transactions, you do 25 remittances a month. Is that a very small, I mean, give me some sort of understanding of, is that a significant number of transactions or a very insignificant?
It's almost, it's not even a decimal place in terms of our total number of transactions. And the reason it's so small is most credit unions are community-based. We're in the heartland of Ohio. We don't do a lot of remittance outside of the country, but we do some. But
Some, because you've got some folks on Wright-Patman Air Force Base right there. Okay, so that would be discontinued. Now, Dr. Calabria, in terms of this question about access to credit, I had two of my colleagues, two of my Democrat colleagues mentioned your testimony. Congratulations, they read it.
I'm touched.
Unfortunately, they didn't agree with it, and I wanted to see if you had any response. One question was directed to the availability and the cost of credit that you outlined as a direct result of the CFPB, meaning, as you outlined, there's less credit available and it's more costly as a direct result of the CFPB. We outline.
Let me first, because I'm not sure that I think, certainly Ms. Maloney and I might have put different emphasis on it, but, I certainly agree, and I guess I should say as a broad matter, all of these things have costs and benefits. And the question is whether the costs outweigh the benefits. And so I would never be one to say that the CARD Act has not had some benefits, but I would say that consumers have had to pay for those benefits. They did not come free. We didn't turn lead into gold here. So the question is whether, again, those costs outweigh those benefits. So I wouldn't disagree with anything she actually factually said. I would say it out and just say, consumers are paying for those benefits, and they're not necessarily given a choice whether they pay for those benefits or not. So that's part of it. The other part of it in terms of the interest rate increase is, again, looking at the spreads that we've seen, and as I detailed in my testimony, a lot of this is from regulations that pre-existed the CFPB, that transferred to the CFPB, and as I also note in my testimony, the increase in spreads for credit card market was after the CARD Act was implemented. You saw an initial increase in the recession and a very large increase. There's a nice chart in there that I'd like to think that anybody could understand. So, again, very direct that these are costs. We've seen interest rate increases. I'd put it this way. If we believe that the Federal Reserve lowering interest rates creates jobs, then we must therefore believe that interest rate increases destroy jobs. And so if we believe that these things have costs and those costs are going to be borne in interest rates, then we must believe, of course, that they have job consequences.
So you're not from the South, are you?
Well, I will say that I was very fortunate that all of my mother's family grew up in Guilford County in North Carolina.
That's amazing. You are the fastest talker I've heard.
Well, my father was from Brooklyn, so they kind of split the
there we have it. No, I certainly appreciate that. But with that, I recognize the ranking member, Mr. Quigley.
Thank you, Mr. Chairman. Mr. Calhoun, the financial crisis coupled with housing mortgage crisis that went with it, and the topics that you alluded to, much has been said about the quality of lenders, that it was the principal reason that we were borrowing to people who couldn't afford the product, and that led to this problem. To what extent do you credit that? To what extent do you credit the features of loans in this process? And then generally, how would you rate the two in terms of how important they are? The terms of loan products determining loan performance versus the quality of the lender?
Thank you. Thank you. We've done extensive research in this area and published it late last year. And one of the striking things you find is one of the primary determinants of how a loan performed is what type of loan the borrower got after controlling for the borrower profile, credit score, loan to value, etc. Same apples to apples borrowers, one gets a subprime loan with lots of abusive practices, much, much higher default rates than the same borrower who is put in a better loan. And one of the real challenges is, and I think for all the industry representatives here are part of the responsible industry. And they found that they had to compete with those folks who were offering the deceptive and abusive products, and it's hard to do. If somebody comes and offers a tricked-up loan for a $1,000 a month payment, you see ads for these still on the Internet today, that doesn't have escrow, that has a teaser rate that jumps after a year, it's hard to offer a sustainable loan that would have maybe a $1,300 or $1,400 initial payment. That's a hard loan to offer to compete with. And if I may, just quickly, I want to respond on the credit cards, where we have also done extensive research. And I want to point out three things, and these reports are also on our website. First is the main change that you saw following these reforms was there was a change in the rates that people paid, and it moved by close to 2%. People started paying the rate that they were being offered. Before, there was about a 2% gap between the rates that people were being offered, and then you measured the rates they were actually being charged. And that gap has almost entirely disappeared. Second, we looked at impact on credit, and so there is a bit of an experiment out there. We looked at how business cards performed, and consumer cards did as well or better than business cards, which is noteworthy because the Card Act protections don't apply to business cards, but do apply to consumer cards. And third, our most recent study looked at what happens to the credit card lenders. If you look at the credit card lenders, those who offered the most abusive products suffered the greatest losses in this downturn, and in fact, a number of them went out of business. And so I think the Card Act is a good example of how consumer protection, if done carefully, helps consumers, responsible industry people, and the overall economy. We want to acknowledge, though, it is very hard to get this stuff right. And everybody wants the easy answer, but this stuff is hard to get right because there are huge impacts on consumers and businesses.
Doctor, if anyone can squeeze in a reaction to that in a minute, you can.
And I'm trying to be respectful of time, which is the speed of talking here to some extent. Honestly, most of that I agree with. I mean, I think it's very hard to get right. I spent a number of years working as staff on Senate banking, and my walking away from seeing the reaction of all due respect, much of Congress in Washington during a crisis was they're not going to get it right. And so some of my sense of having that constrained, Mike mentioned bright lines earlier. I think part of the problem with our vast array of consumer protection, both pre- and post-crisis, is it's ex post. It's a lottery. It's somebody finds a technical violation without actually giving clear. It's not, I think it is reflected in my bio. I spent some time at HUD running the RESPA office, which has since transferred to CFPB. I'd be the first to say our consumer disclosures work horribly. I spent a fair amount of time trying to fix them so they would work with consumers. But the tension was, I found many of the consumer advocates didn't want simpler disclosures because they wanted to be able to sue under various deal or reasonable tests, and they wanted a whole lot of detail because they...
Just once, Mr. Chairman, you'd be allowed to answer without, I don't want you to feel as rushed as you perhaps might feel.
Sure, absolutely.
Thank you.
I ask unanimous consent for how much more time? Do you want 2 minutes?
2 more minutes.
Thank you.
I ask unanimous consent for 2 more minutes.
So let me mention a couple of things that I think I very much agree with and will emphasize. One should be, as Mike mentioned, many of these worst businesses went out of business. And that's part of the problem with our financial system is, in a market that works, if you have bad practices, you take losses, you go out of business. Now, if we're going to bail people out and protect them, then of course bad practices are going to proliferate. So the first thing should be no bailouts, and we'll weed out the bad characters, which do eventually get weeded out. Michael also mentioned, in terms of looking at mortgages, that they held constant credit and LTV. I would say that there's nothing more predictive of the performance of a mortgage than credit and loan to value. So I would be the first to say all those little other things do matter, but they matter far less than whether someone has equity or not. For instance, was mentioned the ability to pay, and Michael mentioned the number of 45%. Well, FHA today, you can get up to 42, 43% debt to income with 3.5% down. That's reckless lending to me. That's predatory lending, but the Federal Government is pushing it because, God forbid, we expect money to come up with a down payment and put their own skin in the game. So what I would say is my skepticism is, and I think this is particularly important when the CFPB is on its agenda later in the year to roll out small business data that mirrors the HMDA collection, is that we've seen this pressure over the years. The regulators were foremost. I mean, if you haven't read the Boston Fed study and the Boston Fed guidance from the early 90s where they said, look at things like reduced debt to income, more flexible underwriting. So my concern is that what we've seen this play out in the past is that you've seen a pressure to get more people in the loans that, in my opinion, were predatory features because they did not protect the borrower. And of course, there's some things we'll disagree on. For instance, I think the fact that most of our mortgage market is non-recourse is problematic. You go to France, socialist France of all places, if you don't pay your mortgage there, they garnish your wages. And guess what? They have much lower default rates. So if you want to avoid a crisis, we have to ask the consumer to actually live up to their obligations as well. I know that that's never going to be politically popular, but if you give people a free option to walk away and bet on the housing market, they will take it. And that's how we get into these gambles as well. So I will say there was absolutely fraud, absolutely predatory lending, but I disagree that I think that those are the main drivers. I think those are the result of the bubble rather than the driver of the bubble.
Thank you, Mr. Chairman.
I thank the ranking member. It's a solid set of questions. Mr. Kelly of Pennsylvania is recognized.
Thank you, Chairman. And thank you all for being here. Being in the automobile industry, so I've really watched over the years what's happened. I think the number one thing that happened to us was the ability to finance negative equity. In putting people out there 48 months and 60 months and 72 months on something that depreciates very quickly. And so that the great realization was when we'd sell somebody a car and then they'd come in and they'd say, wait a minute, this doesn't make sense. And I said, well, you have negative equity from your trade. And they say, what's that mean? So you owed more than it was worth. And I also sat in the bank advisory board. I used to watch them okay loans, and I said, you can't possibly do this. This isn't going to work for you. So we want to participate at the government level. We have to with Fannie Mae and Freddie Mac. So a lot of what we're experiencing are just market fluctuations and people allowing people to do bad things. And I often think that if we had followed the 5 C's as carefully as we should, and you all know what those are, we wouldn't win them now. But what concerns me, because the hearing today was on the restriction of consumer access to credit. Please tell me, as you go through this process, and as you look, and I know some of the things aren't on paper yet, but it is the uncertainty truly. If this economy is to get back on track, access to capital is the same as the body needs blood. And unfortunately, there's a transfusion that's necessary right now. Most people don't have access to it. The cost of credit. Mr. Fecker.
Well, I think that's a great point that's to be made. As a practical matter, what the average credit union will do as they seek to try to figure out how to absorb these increased regulatory costs into their operation is they won't just raise the interest rates on the loans or increase their fees, A, because the market won't let them, and B, because it's simply against what we try to do. What we will do instead is try to control the costs that we can control. You can't control the regulatory cost, but you can control who you lend to. And so, again, as a practical matter, as this crisis unfolded, at my credit union, we increased our credit standards. We just stopped lending to people on the credit margin because we wanted to control our loan loss cost in the end. And it worked. Our loan loss costs went down, and that's the way we managed that whole crisis. But by doing that, we stopped making loans to people that probably would have paid the loans. We just couldn't take the risk anymore. And so when you talk about what happens when the cost of your operation goes up, it's not as if it's obvious in the rate of the loan, at least at first, or in the fees that you charge. You make other changes to try to absorb those, and those changes very often result in a reduction of service to the member. That was one example I gave. My other frankly, favorite example is, I believe, my opinion, the reason payday lending got such a great start in this country is because we made it so expensive for traditional lenders to make small dollar loans that they just stopped making them. And so as soon as they stopped making them, it created a market void that was filled by people who exploited that void. And so we couldn't be stronger supporters of strong consumer protection, but it's got to be balanced with the cost of providing that, because the result is not necessarily going to be higher loan rates, at least at first. It will be a reduction in access to products that, frankly, people need. And it does play out, and again, I say as a practical matter because that's what's happened at our credit union.
Mr. Zeisel.
Yes, absolutely. When the access to credit is constricted, people at the margin are the ones who suffer, and they're the first to lose availability of products, and the first to be unable to afford the products that are charged. For the most part, costs that go up do get passed on in one form or another to consumers. There's no other way to operate a business. Eventually somebody pays, the customer will pay in one form or another, or the product gets dropped and the customer loses the availability of something that's valuable, that's a valuable product or service that they need, and they end up going elsewhere to find it.
Yeah. Dr. Calabria. The reason I wonder about this really, because competition truly does drive quality and cost. And whenever we start eliminating smaller banks and credit unions and the ability to compete, then all of a sudden it goes to one place. That's why I said earlier, too big to fail means too small to survive. You can game this thing to the point that you take people out of the market that they were in before. So I really think that sometimes we lose fact that down here.
I mean, I absolutely agree, and I think one of the things we did not fix was too big to fail. If you look at the largest banks and institutions, I mean, look, before 2008, the largest banks had a higher cost of funds than the smallest banks. Now, they have a lower cost of funds than the smallest banks, and they will be able to gain market share, and they will become even bigger. And we have, and it's more important. Another element of that is, as I mentioned before, if you've got bad business practices, you should go out of business. But that doesn't happen when people think you're going to be bailed out. There's no market discipline. There's no constraint on you. So one of the real problems in our mortgage market was just an absolute lack of market discipline on our largest lenders, and not just Fannie, Freddie, but Bank of America and the whole slew of them. We're just not subject to market discipline. And that, to me, what should have been the first and last objective of financial reform.
Yeah, and I mean, really, if there's no consequences for bad business practices, then keep doing them.
Yeah.
Why would you stop if somebody's going to bail you out? I know in our business, you do the wrong thing, you can do it for a while, but you can't do it for too long because you're out of business. And I think that's what we're witnessing now. And my real fear is this cost of capital and the availability of capital, the access to it, is really hindering our recovery right now. I know we talk about we want to make sure it doesn't, it's easy, we're protecting consumers, but what we're really doing is we are limiting the access of capital to people who need it, and it's...
And we're shifting capital to those who look like they're going to be backed by the government.
Okay. Thank you, Mr. Chairman. Thank you.
I certainly appreciate the member, my colleague from Pennsylvania and his line of questioning. I've got just a small set of questions left. Mr. Zeisel, based on your experience, and this is what I want to get to the heart of, in my questioning I asked Director Cordray about the term abusive. Now, unfair and deceptive have been well-defined legal terms. There's been a significant amount of legislation and litigation to define those terms, very costly terms to define. But we've got a body of law to look at now. There's an understanding by the private sector, there's an understanding by regulators what those two terms mean. Abusive, however, as the Director testified before this subcommittee at the beginning of this year, they don't intend to, they're going to use fact and circumstance to determine that. It is not something we are likely to be able to define in the abstract, which is interesting. What is that effect?
Well, that goes directly to the issue of uncertainty that we've been talking about, and the expectations of financial institutions as they're being either supervised by the CFPB or enforcement or simply rule writing. So, as you say, unfair and deceptive have been around for a long time. They're defined terms. They've been through the courts, and they've sort of been vetted through the system. So financial institutions have a sense of what that means and how they can develop strong compliance management systems to deal with that and to anticipate and make sure that they're not in violation of the law. You have a new term here, and that new term is in Dodd-Frank, and there is, as he said, a sort of a three-part or multi-part
but in their manual, they only discuss about a half of a page to define abusive.
That's right. And the manual actually has sort of language throughout that addresses issues involving general risk to consumers and that appear to go to issues
so how does that affect?
That might be UDAP related, and I think it raises a lot of doubts and uncertainties in the minds of financial institutions. How do you prepare? How do you plan? How do you develop your products and services and know that they won't later be found to be in violation? It's a difficult problem.
So what does that mean for access to credit, the subject of this hearing?
Inevitably, as everybody has said, the products and services that are being developed by those financial institutions to meet consumers' needs are the ones that get affected, and the ones at the margin are the first to get affected.
Sure. Now, my question for the whole panel is on the qualified mortgage, the QM, and this definition, its importance, and tell me how you'd get it right. I just want you to take, if everybody could take, very briefly summarize your view on how we get this thing right so you can still have mortgages can still be made by large and small institutions, and there's still a competitive marketplace for consumers.
That QRM is one of the biggest fears that we have. Getting it right is going to be critical, especially to the small institution. Just to make my remarks short, I think the safe harbor portions of it are going to be really important, especially for the smaller institution that's going to want to be serving their member with mortgage loans and not wanting to be looking over their shoulder the entire time they're doing it, that somehow they've tripped over some tripwire in a regulation that will get them in trouble at some point. So the safe harbor provisions, to me, are one of the most important aspects of that entire regulation.
Yeah, well, I would have to agree, and I think that again, to keep it brief, we're dealing here with the need for a broad standard. This is essentially a box, and people aren't going to make loans outside of the box for the most part. So if there's going to be lending done, and even I think I heard Mr. Cordray say he didn't expect, at least in the short run, that there would be a lot of lending outside of QM. That makes it all the more important that QM be broadly defined in a way that makes sure that lenders can make safe loans to the widest number of people possible, and the clarity of those rules are also critical. The safe harbor is important because there's a great deal of liability risk associated with getting it wrong, and that will happen. It'll come up in the foreclosure stage. And it'll involve a great deal of cost to litigate at the very least. So if you're going to create some kind of sense of certainty around what it is you're doing and feel comfort that you will have and meet the ability to repay test by using the QM standard, you really need to have a safe harbor.
I think there's good news on this issue in that there is broad consensus on the goals and a lot of the specifics. There is agreement that mortgage credit is too constrained. I don't hear any groups arguing otherwise on that. So there's broad consensus that it should be a broad QM market. Second, I think the industry has convinced others that there should be bright line standards, although there's some downsides to that. The Fed raised the question of maybe it should be just a general bar of do you meet generally recognized underwriting standards. That was going to be the test of whether or not it was a QM, but I think now there is consensus. There's still disagreement on the rebuttable presumption. I think, though, there is a lot of consensus around that. People want litigation to be very rare fixing mortgages is not that helpful for borrowers and is very inefficient. It should be a deterrent, but not by any means a frequent occurrence. And I think there's positive news there, too. The liability and standards proposed under QM are much less than those that are in the North Carolina Mortgage Act. That has been on the books for over a decade and has produced virtually zero litigation. And so I think there's some assurance in that, because CRL has not supported any state or federal laws that have generated widespread litigation. We just don't think it is effective. It's not politically sustainable either. So we're not going to advocate that. And finally, there is, I think, consensus again on the relationship between the QM and the QRM. The QRM, as everyone knows, is written by 6 different agencies jointly. Those agencies are given, it must contain all the same standards as QM, but then they have authority to add on to that, and quite frankly, their original proposal piled onto that with deep restrictions that our analysis showed would knock out about 25% of people who should be in the mortgage market. We think that there's no basis for that, that particularly at this time, they should get the QM, get it right, preserve broad credit, and make the QRM no additional requirements. If you meet QM, you meet QRM, take a look at it in 5 years and adjust it whichever way you need to, is what we recommend.
Well, I'll say I think there's a tremendous amount of consensus here. I would echo some of the very same things. I do think it needs to be broad, and I do think that anything outside of the box will disappear, at least for a few years, if not permanently. I will echo that I do think you need bright lines. As a general matter, I think a basic principle of law should be you should know whether you're in conformity with the law ahead of time or not. There shouldn't be a lot of ambiguity with that. And again, I think safe harbor is a very important part of this, particularly in the foreclosure stage. I don't think we want to move to a world where mortgages become unsecured lending. That will very much see rates go up. One of my concerns, and I would echo, I think the QRM and the QM should be coordinated and made as close as possible. One of my concerns is that in the QRM, we've exempted some government loans, and so as someone who doesn't want to see us put hundreds of billions into another bailout again for Freddie, Fannie, or FHA coming down the line, I would suggest that the CFPB treat government loans equally as it treats other loans and to show no preference and no exemptions for that, because, again, ultimately the taxpayer stands behind those.
Thank you. Thank you for that. Does the ranking member have any additional questions or comments?
No, thank you, Mr. Chairman. I thank our panelists.
Thank you. Mr. Keller, do you have any additional? Okay. I thank the panel. Thank you for your patience in waiting through the questions this morning. It's refreshing to have a panel, a diverse panel, actually find some agreement on QM. That's very encouraging and refreshing. And I don't want to describe it further, but let's just say it's rare. So thank you so much for your testimony, your interest in these issues, and your willingness to engage in a diverse array of questions as it relates to access to credit. Thanks so much. And this meeting is now adjourned.
Thank you.